How I choose stocks, a beginner's guide to investing. The most important quality of an investor is temperament and not intellect, said Warren Buffett, one of the wealthiest men on planet Earth. And you don't need to have a high IQ. All you need is the right attitude. So if you want to invest, go for it. And don't worry, because in today's video, I will share some guides to investing that anyone can follow. And best of all, I'm not going to sell you shit. So listen up. What do you think of that? That's good. That's me. Hi, I'm Munif, a self-made multimillionaire with multiple brick-and-mortar businesses that have closed billions of dollars in sales. I'm not selling anything here, and the purpose of this channel is to teach you what it takes to become successful through real-life experiences, because I really want to create financial literacy, and I know the impact of not knowing what to do with your money. So if you like this type of content, hit the subscribe button and give this video a thumbs up. Before diving into investing, you should understand first that it has risks, whether individual stocks or index funds. They all have a certain amount of risk and a potential for losing their value over time. While there are various reasons like market crash, inflation, or a company's major decisions such as a merger or at worst bankruptcy, which could lead you to lose all of your money. And I'm not here to convince you not to invest. I'm just making sure you understand the risks associated with it. And that's why choosing what stocks to invest in is one of the most important first steps that you need to take. I mentioned earlier in the video that individual stocks and index funds. I think that these are the two most common stocks for regular people. So before I go on to the tips on choosing the stock, let's first discuss these two. First, it is the individual stock. When you think about investing, the first thing most people think of is investing in an individual stock, like stocks in Tesla or Coca-Cola or Chevron. When investing in this kind of stock, you actually buy company ownership. Imagine that, a part owner of Tesla or Coca-Cola. Anyway, there are two ways to earn when investing in individual stock. The first one is through a price increase. You buy stocks and then sell them when the price goes up. For instance, if you bought 100 shares of Tesla at $265.25 per share, that would be $26,525. And it is predicted that its price will hit 400 by the time 2023 rolls around. So let's say today is 2023 and you decide to sell your stocks. You'll get a gross revenue of $40,000. And in this case, you gain $13,475. And second is through dividends. I've mentioned earlier that when you buy stocks, you essentially become part owner of that company. Hence, when the company makes profit, it distributes that profit to shareholders per how many shares you hold. For instance, if the company has 4 million stocks and you own, let's say 5,000, that would be 0.125. Let's say at the end of the third quarter, they made a profit of $50 million. 0.125 of that is yours, and you get $62,500. Just looking at these numbers, it would be pretty tempting to go ahead and invest in individual stocks. Personally, I don't recommend them for the beginning investor. Sure, there are great advantages and some people win big, and they have unlimited growth potential. And if you decide to hold them to gain dividends, if the company continues to generate profit, you earn thousands of dollars by sitting on your couch and doing nada. On top of it, if you plan to sell them, you have a tax advantage if you hold them for more than a year. This means if you sell them after holding the stocks for more than a year, you'll be paying less taxes or sometimes nothing at all. You get to take home a large portion of your gains. Now let's get into the cons in the stock market. I don't mean the cons in the stock market. I mean the cons of individual stocks. The downside of individual stocks is one of the riskiest investments of all. This is the reason why I don't recommend it for beginning investors. Unlimited growth potential of an individual stock is quite tempting, but it also has a great potential for loss. Our history shows that even the largest and most successful companies are susceptible to bankruptcy. When that happens, you could lose your entire investment. So if you think of investing in individual stocks, make sure you do your research and don't get caught up in the moment or in the fear of missing out. Now let's look at index funds and its advantages against individual stocks. Individual stocks are risky because you concentrate your funds or money in a single company, so your investments are directly affected by their rise and fall. You can try to invest in more than one company with different sectors, but I think it's a giant leap for most beginning investors. So personally, I would recommend investing in an index fund. you can still participate in the stock market, but you can minimize your risk by diversifying your stocks. An index fund can do that without you doing all the troublesome research of every single company's potential for growth and value. With just one purchase, you can get ownership in various stocks, and you can have it immediately and with greater diversification, thus lowering the risk. What happens when you invest in an index fund is the money that you put will be used to invest in all the companies that make up a particular index. For instance, the S&P 500 monitors the performance of the 500 largest companies in the US, and thus your investment is tied to the performance of a diverse selection of those companies. And aside from immediate diversification of your stocks, most market indexes have a good track record. In the case of the S&P 500, it has nearly a 10% average annual return over time. But remember that this return is based on historical data, and the future returns are never guaranteed. If someone promises you 100% guarantee of returns, you better run, because that person is definitely up to no good. Now that we've gotten that out of the way, let's go over what you need to know as a beginner in investing. Don't expect great results from a professional picker or fund manager. According to an Alley Invest survey, 65% of adults find investing scary and intimidating. So, for those who still want to try investing, their first move to ask a professional picker or fund manager, which I think is not a very wise move at first. There might be a few exceptions, but these people's priority is not the growth of your investment, but to sign you up so they can collect fees and commissions. So do the investing yourself. I know it's scary, and I know it can be intimidating, but you still need to do it. And remember what Warren Buffett said, the most important quality of an investor is temperament and not intellect. And that's right. You don't need to be smart. You just have to have the right attitude. Next is to engage in long-term value investing. Most beginning investors are prone to impatience and panic and anxious buying or selling. That's what caused the whole Bitcoin thing. So they often do short selling and day trading penny stocks and options trading because they get to see immediate gratification and results on their investment. They're not bad, but if you want to earn more, long-term value investing is a much better option. So how exactly are you going to maximize your profit through long-term investing? Well, there are two ways to do that, through quantitative and qualitative analysis. Let's discuss quantitative analysis and how you do it. So quantitative analysis, as the name suggests, is an analysis based on quantity, meaning it relates to numbers. So you study the company's potential growth through its numbers. You can Google it and look at a company's income statements, their cash flow, their balance sheet, and earnings report. Fancy way of saying how much money is coming in and how much money is going. Is the CEO spending everything, or are they stocking cash? It's a great way to look at what a company is doing as far as just finances. For those of you that are not familiar with all these financial terms, if you study these reports, you get an idea of what the company is earning and losing, and if they're paying their debts, or are they sitting on a lot of cash instead of collectibles. These reports will give you an idea of whether the company you're trying to invest in will continue to grow, or will they go bankrupt in a few years. But let's say you have some extra dollars. You can try signing up for an online research platform for dividend investors like Simply Safe Dividend. In those type of platforms, you don't need to do the research yourself because the platform will do it for you, but it can be pretty pricey. You can also try reading The Intelligent Investor by Benjamin Graham if you want more in-depth knowledge about quantitative analysis. This was Warren Buffett's college instructor, and Warren Buffett based a lot of his early years in investing on Benjamin Graham's book. It is a big, thick read though, so I will warn you before you start to read it. If a guy like me, coming from the projects with an illiterate mother and nobody to teach what stocks were about, can do this, you can do this. This is not hard, so let's get into the other side. Now, if there is quantitative, there is also what we call qualitative analysis. The qualitative analysis focuses more on the qualities that make a company great, more than just the numbers that you see in their financial reports. So instead of looking into each company, whether they're making money or which company has fewer debts or which company has consecutive years of profit, you look at things like, are their customers satisfied? Are their products and services being bought all over and over again or repeatedly? Are their employees happy? Is their business model effective? Is their business model going to be around for a little bit? How do they perform against their competitors? How do they treat their stockholders? Stuff that can't be quantified or put into numbers. These things can be difficult to study, and you can Google them as well. But again, if you spend some extra dollars, you can get services like Morningstar. They provide a detailed analytic of investment portfolios. And if you don't have some extra dollars for the premium access, but you have a library card, you can go to the local library and assess their premium services there. And if you want to know how qualitative analysis is done in more detail, you can check out the book Wall Street by Peter Lynch. Thank you so much for watching, guys, and sticking with us until the end. When it comes to investing as a beginner, what you need to do is first invest in yourself. Don't hold back, learn as much as you can. But at some point, you're gonna have to pull the trigger. Set investing goals, whether you plan to earn through selling or dividends. Identify your risk appetite. Are you capable of handling risk of individual stocks? Or maybe you want to play it safe and invest passively in index funds. Lastly, identify what you value most in a company. Is it their growth? Is it their value? If it's their growth, you can focus on the quantitative analysis and looking at the numbers when choosing the stock. But if it's value, maybe you want to look at qualitative analysis. But if you ask me, I say use a little bit of both. You can't expect a company to grow continuously if they don't treat their customers or employees properly, or if you don't have an effective business model. On the other hand, a company can't thrive without the means to do so. They need resources like money and assets. That's all for today's video, guys, and I hope that you found this content valuable. And if you want to be notified about similar content, please go ahead and hit that subscribe button and notification bell. Please don't forget to give this video a thumbs up. And if you're still hungry for more, check out the next video, how to invest your first $10,000.